So we'll start with the beautiful new important bit lengthy chapter called business combination. Okay, so this is the again starting point for a subsidiary consolidation. So we'll try to understand this. It's a very simple actually. Okay, if you understand it, because it's just one journal entry. And now we come across the preparation of the balance sheet, and we have to understand schedule 3 formats also, which in 110 we will take it forward. Now what we are going to talk about in this particular standard is the business versus asset acquisition, because today's day, all cheating manipulations everywhere. They acquire the assets and they call it business combination. They acquire the business and they call it asset acquisition, because accounting is going to be different. In business combination, goodwill is going to come. Asset acquisition, goodwill is not going to come. So how do you differentiate when something is acquired is whether assets are acquired or a business is acquired? That is what you should know first. Otherwise somebody will simply see, I will acquire your building, I will acquire your land. Did I acquire your business? I say no, I don't want your business. I will do it. I wanted to get your business, get your properties, not the business. So we need to understand, because only and only if you acquire the business, then business combination becomes applicable. Otherwise we'll go to PP, we'll go to Ind AS 38, we'll go to Ind AS 40. Now what is a business combination? What is if it is a business combination, in the first step only if it is gone, then second step, third step not applicable only. But if you prove it, yes sir, it is a business combination, not an asset acquisition, then how should I account that? Then it goes with certain 4 steps model. We'll go step by step. Then what if it is a common control combination? That means before acquisition, after acquisition, the owners are same. Then we adopt one method called a pooling of interest method. Here, if it is a business combination, we acquire purchase acquisition method. And there is one more beautiful concept, okay, called reverse acquisition. So we apply reverse acquisition accounting. So we have to understand and differentiate. That's it. This entire chapter is going to speak about these 3 things. That's it. The first is very small aspect. Within some 10-15 minutes, we will finish it off. And there is nothing much discussion, hardly 1 or 2 questions may be there. But rest of the questions, rest of the concepts will revolve around 3 things. Is it a business combination? Means what business combination means? Not under common control or reverse acquisition. Then purchase acquisition method, pooling of interest method, reverse acquisition method. And lengthy questions. We have to understand how to solve that. Okay, I don't know how many times I should tell it simple. Now Ind AS 103 versus Ind AS 110, how it is different? Both deal with the consolidated balance sheets only, financial statements only. Now 103 defines initial recognition and measurement rules. It is the starting point for consolidation. With 103, you will prepare one consolidated balance sheet, and for the first time. And subsequent consolidation rules are defined by 110. So both are different. If you ask me, 103 is much simpler than 110. But 110 you can never occur unless 103 is done, because for 110 the starting point is goodwill. Goodwill comes into picture only with 103. Nowhere. And goodwill comes into picture only in the consolidated financial statement, not on standalone, because Ind AS 38 doesn't permit you to recognize goodwill, internally generated goodwill. That means if you see in anybody's balance sheet goodwill, that means it must be a consolidated balance sheet and not from associate. It will come only from acquisition of a subsidiary. Now, terms like merger, acquisition, they are very narrow, because they go with the net assets, equity, interest and all. But to today's day, the business combination is the very wide. They have used these terminologies rather than mergers, acquisition, amalgamation. Because if we study accounting standard, they come with the amalgamation, all those things, no? It doesn't use that, because they have understood how the people are going to fool. You know how to control the business. You can control the business by transfer of cash, straightforward case, or incurring the liabilities. What is this incurring the liabilities? Now, one of the instances, Anil Ambani didn't have the cash. He was supposed to be like jailed or something like that. Mukesh Ambani paid that liability. Now, in return, Mukesh Ambani can ask, no, give me that company. So there is a business combination. That means what is the purchase consideration you paid? You took over somebody's liability. That itself is your purchase consideration. It was not given to you, it was given to third party. Business combination can happen. Then see how beautifully, intelligently business combination can happen. I will pay to third party, your business is mine. I can draft the contract as per the requirements of the taxation laws. And this contract may happen in Mauritius, not even in India. Asset is located somewhere, contract is happening somewhere. Now, how do you catch it? We need to have that understanding. Maybe my role is an auditor in that company. How do I understand the whole scheme, not scheme I say, whole scheme of things? You may issue the equity shares, that is also a straightforward case. Maximum cases happen like this now. Cash is very small thing. Without transferring cash also you can do a business combination. How? You don't transfer the cash, nothing. Business combination can happen. Other assets and liabilities, or by contract alone. Like suppose bank audit we have to get. They said minimum 10 partners should be there in your audit firm with 10 years of experience. Chalo, you are audit firm with the 5 partners. I am partner with the 5 partners. We will form a new partnership firm. And all 10 partners of that partnership firm will apply for one bank audit. All the partners have got 10 years experience. Finished, no? So there is one business combination by the contract alone. Followed, no? So these are all the cases where you can have the business combination, okay, without transferring the cash. Like I don't need to do anything. Okay, I have given you, okay, maybe some technological services I have given. And till the time I give you some technological services, maybe I have got a representation over the board. So these are all the cases of the control over the business. Now, how do you differentiate versus business as asset acquisition? For this, you need to understand what is business. Then only you will be able to differentiate. Business is an integrated activity which receives inputs. The process plays a very important role, which gives you the output. Combination is an acquisition, common control, or reverse acquisition. So, you have got a business, somebody acquires it by paying whatever consideration. It is a business acquisition. If what I acquire is mine only, that means within the group companies, then it is a common acquisition, common control. And reverse acquisition is one small entity, relatively a small entity acquires a very big entity. That's the concept of a reverse acquisition. But all these things should happen over a business. So what is a business? It's an integrated set of activities. You do certain things there. Why? To convert the input into output, sell the output, and provide the return in the form of dividend to their owners. Ultimately, a cash. Business is a cash generating unit. A cash is going to come from there. How do you earn the cash? By selling your products. So whom you sell the products? The one who has got a problems. See, ultimately, every business is the solution providers, no? Somewhere or the other, everybody, everyone outside, like there is one rickshaw guy, there is one flight. Every people try to solve our problems. Their product is nothing but solution for our problems. Followed, no? So elements of the business includes your inputs, the economic resources. We need certain economic resources. Like suppose if I'm the business, is it my business? Can somebody take over me? Okay, see, I have got certain inputs here. I have got a projector, I have got the teaching material, I myself as a faculty to teach. We are all the inputs, and I do have got certain processes. Convert into an output form, which is ready for use. And why do you need it? Because you have got certain objectives, correct, no? And you try to fulfill that objective with my product. Now, it is like anything. It can be people, processes, rights, intellectual property rights. These are all the inputs. Processes includes any system, standard, rule applied on the inputs that creates the output, like operational processes. And the process does not include your accounting, payroll. Like I have got a tally system there, I am doing accounting and all. That is not part of my processes. That's the back end office. The process includes the main process, like I am teaching here, or I will have a recorded classes. That itself is a one product, because certain processes have gone through. and the output result of the input and process applied, output provides the return to the investors. Ultimately, when I come with the recorded classes or I deliver the output to you, that gives me the return. Followed, no? Now question comes, once, say for example, I teach all the subjects of CA final, not say once upon one day, in somewhere in the future, somebody takes over. Now what they take over? Do they take over my entire business, or did they take over one asset from me? Did they take over books from me, the processes from me? It's complicated, no, to understand, because with the help of contract I can say anything. I can always say that I have went into employment. So when I go and join as an employee, I will take over everything, every processes, every inputs, everything. I'll go and sit there. See how easy it is to manipulate. Rather than telling purchase consideration, you say paid salary. So that's why you need to have that understanding. So acquisition of the group of assets versus asset acquisition, how it is different, because intangible assets are recognized at a fair value. If it is a business combination, every assets are recognized at a fair value. However, in asset acquisition, you do a cost allocation. You fix one price and you distribute that among all the assets. Goodwill is recognized. Goodwill is never recognized in asset acquisition. Transaction costs are treated as an expense, but transaction costs are capitalized in asset acquisition. We add it like registration fees of land. We add it to the cost of the land in PP. That's what we learned, because without that it is not ready for available for use. But business combination doesn't go with that concept. It says that, look, your transaction cost doesn't increase the fair value. It's not going to, it's an expense. When it comes to your, what is that called, financial instrument, transaction cost goes with the classification of the financial asset. If they say that if you are amortizing the asset, you amortize the transaction, means it's an expense only. You have to take it to P&L account. You expense it over a period. But in business combination, they say take it to P&L account, don't capitalize it. So it's very important to decide the nature of acquisition, because accounting is going to depend on that. So somebody has to apply their mind. What happened here? Who is taking over whom? For this, there is one test which is given. See, this question is not asked till now. There are two questions in the examination question. They may ask you in the new syllabus. It's called a concentration test. This is an optional test. If you want, you can do it. It is based on transaction to transaction basis. This is introduced for simplified assessment of the asset acquisition. If the concentration test is met, then all of the fair value of the when the concentration test is met, like we say, business CCFC test is met, fixed for fixed test is met, like this, when the concentration test is met. What is concentration? Focus. Concentration. One, it said that if all the fair value of the gross asset, say FVGA, is concentrated on a single identifiable asset, like somebody takes over 36 chambers. Now, whom they pay money? They pay some X amount of money. We will value everything. We will value this computer. We will value the books. We will value this projector. We will value this building. We will value me. Now question comes, what did you, when you paid some money for this business as a whole, is that money revolves around one asset, or it is equally spread across all? If it is spread, if it is revolving around one asset, then it is an asset acquisition. Other things are ancillary there. Followed, no? Then they may have to treat it. Suppose somebody acquires me, they have to treat me like an intellectual property, like I am an intangible asset. Okay, for this we are not yet finished. Actually, I should have done intangible asset also. Then you would have understood. Can we treat employees as an intangible asset? No. But if I acquire somebody on a contract basis, can I treat them as an intangible asset? If I can stop them from not working for others, I can take them as an intangible asset. So see how different it will be. So somebody can say 36 chamber acquisition, somebody can, if it fails, if it passes concentration test, it is not a business acquisition, it becomes an intangible asset acquisition. Which one? That is what the competitor, there will be some fees paid, and you can restrict that player or whoever not to play from anyone else. They can restrict me not to compete into that particular segment. Followed, no? See how accounting is going to be different. So how to calculate this FVGA, fair value of the gross asset? Purchase consideration, whatever you have paid. If you have not acquired 100%, then you have to add NCA also. And if you are already had a previously holding something, that also you consider the fair value of the previously held equity. Okay. See, before I give you this format, I'll just tell you one format of goodwill calculation. It's nothing but a journal entry as such. When you acquire the business, your goodwill calculation formula is purchase consideration, add NCI, add fair value of the existing holding minus fair value of net assets, gives you goodwill. In terms of accounting entry, net asset account debit, to NCI liability, to cash or investments goes out, to your investment at a fair value. Yesterday we did that in India's 28. One associate goes out. So 20%, entire 50% associate goes out, 30% 109 comes in. Like this. So we have to value that entire associate or whoever it goes out. Now, in this net asset, there are two things: assets, liability. That liability, instead of minusing, I can add liability. No? I'll add the liability also. That means liability acquired, your liability acquired is the purchase consideration given to you, minus cash and cash equivalent I will remove, because it makes no sense. No, I will pay cash, I'll take your cash. Deferred tax and goodwill arising from deferred tax liability, goodwill arising from deferred tax liabilities, I will just ignore it, because these are all fictitious things. If I take this, I get the fair value of the gross assets acquired, which includes your PP and intangible assets. Follow? So now, if all of the fair value of the gross assets is concentrated, now I'll go to the balance sheet. I will check, is this value is substantially equal to any one item of the PP, one item of the intangible asset? If answer is yes, I will say concentration test is met. This is not a business combination, this is an asset acquisition. It is an optional thing. If you want, you can do it, else you can leave it. So if the concentration test is met, it is not a business combination and you don't need to do any further assessment. Just pass one accounting entry, asset account debit to cash. Finish. Goodwill and all doesn't come into picture. NCI, consolidation you need not prepare. But if the test is not met, you have to do the further assessment to check whether there is a asset acquisition or not. Are you clear, students? First part. Asset acquisition concept is clear. Okay. We will check certain theory on this. Some theoretical question. Yeah. There is one major asset. Namesake. I told no. Suppose if 36 chamber is taken over. Now, why somebody are they interested in the projector? Are they interested in the laptop? No. They are interested in one intellectual property. Say me, my thinking or my way of daily teaching. So if they take over, what they take over? They are actually taking over me, no? Follow? So this becomes not a business combination. This becomes one intellectual property or intangible asset acquisition. So you can name it by telling, oh, I took over 36 chamber. But if it is happening to be a concentration test is going to be met, then we can treat it not as a business combination, we can treat it as an intangible asset acquisition. Like I'm just giving you one example so that you get connected to what we are discussing now. This should happen at a high level. Let us see one example. These questions may come. Okay, only 2 questions I have taken. And this is a new edition. Previously it was not there. An entity acquires an equipment and a patent in exchange of 1,000 crore cash and land. Okay, understood? The fair value of the land is 400 crore and the carrying amount is 100 crore. Fair value of the equipment and patent estimated to be 500 crore and 1000 crore. The equipment and patent related to a product that is recently been commercialized. Now, equipment and patent, no, some recent launch has happened. We don't know how it's going to happen, but somebody thought that, okay, this equipment and patent can be worth in upcoming days. So immediately they went and acquired it. The patent and equipment has been acquired. Now this market is still developing. Assume entity incurred no transaction cost for ease of convenience, tax consequences also ignored. State how should this transaction be accounted? Okay, it should be asset acquisition because we don't see any business there. It's not commercialized, yes. Yeah, it's actually a PP only. So it's more like a PP. Yeah, in fact, there's no one not, yeah, see, again, it's very important that you should get exposed to it. At least today you have seen this and understood in which context we discussed. See, the possibility of striking to you by looking at this question that is 103 is very high. And if you have never seen this question, yes, you are totally clueless in the examination hall which question is this. That's why my suggestion, at least once, you should have read somewhere, gone through. When before having the control over the subject, reading all these things is useless because it will not sit in your mind. But once you get a flow over the subject, once you get that, okay, exactly what is what, which standard is what, just one round of reading, one round, enough. It will go and sit somewhere. Clear, Nagabhushan? Yeah, I agree. Otherwise, how you will come to know what it is? Yes, state how this transaction should be accounted for. What journal entry I need to pass? Okay, have I given the journal entry? Yes. Okay, you will say it's an asset acquisition. Yeah, because there's no point of business combination or there's nothing told that business is acquired because there are certain conditions, rules and all. We will see what it is. Now, if that is the case, what accounting entry I should pass? You will tell me equipment account. Can I say PP? Debit. Patent account debit. To cash 1000, I will help you. To land, that also you, if you want, I can help you. Yes. Now tell me, at what value I should recognize? Huh? Now we will go back to PP. Okay, so now, which is fair? Okay, what is the total purchase consideration here you have considered? So, what is the fair value of this? Fair value of the equipment and patent 500,000. You can measure it reliably, and it is a barter system. What is the fair value of the land? 400, and the cash is 1000. So, is my purchase consideration 1400 or 1500? Question is clear? See, the fair value of these two assets are 500 plus 1000. Fair value of cash is 1000 only. Fair value of the building is 400. The fair value of equipment. Now, what is that I should recognize PP and patent with? 1500 or 1400? Huh? Okay, let us go back to PP. Let us see. I don't know what answer they have given me. What does my PP says when you acquire for other than cash, like under barter system? First thing, is there a commercial substance? Yes. On what basis you say commercial substance is there? What is the test? Is there any rule for commercial substance? Or simply you say commercial substance is there? Okay, yes. How do you tell evaluator that there is a commercial substance? Sorry? Equipment and patent is different from land. It has both, yeah, commercial value is there. But will you tell the evaluator because there is a commercial value, there is a commercial substance? Nisha. So you have to tell the, see, use one word, the configuration of cash flows and the risk. Enough. Evaluator will understand that you have understood it. See, that is the communications skill. Your answer is correct, but how do you tell them? So you have to tell that, look, what cash flow I am going to earn by using these two will be totally different from what cash flow I will be earning using these two. That's why it has got a commercial substance. Now, second, if it has got a commercial substance, how do you value it? Fair value. Can you measure the fair value of the asset given up? Can you evaluate the fair value of the asset received? When both are evident, given up. So this should be the value, right? How do you distribute? See, 1,400 is the total consideration. If you would have taken fair value of the asset received, you would have told 500,000. But now 1,400, how do you distribute? You have to distribute, no? You use the fair value of the assets received, use as a basis to distribute the fair value of the asset given. Perfect. Okay, let us see how do you say this. 103 does not apply to asset acquisition. Say again, maybe in the examination they may ask you, is it business combination or asset acquisition? Possibly they may give you more clarity on it. So then you should say that, look, asset acquisition is not going to apply because that does not constitute a business. In such case, you have to identify the individual assets, allocate the consideration, and there is no goodwill coming into picture. In the given case, yes, it does not represent a business combination. The fair value of the land appears to be reliable, so total purchase consideration to be 1,400. Now we go back to PP. You see the interconnection. The entity should record a gain of 300 crores for the land. Why? Because book value of the land goes out 400, 100, and fair value is 400. So the allocated consideration should be based on 1,400 should be allocated based on 500 and 1,000. So your accounting entry will be equipment, not for understanding only, not in examination. Equipment to patent 467,933, to bank, to land, and difference is P&L. If at all the same thing was a business combination, because question is very silent, you can also tell some logic there, and because I probably you say not a business combination, equipment would be 500 at a fair value, 1,000, bank, land, gain on P&L, and this difference will go to capital reserve. See how the entries and the values are different now. There is one example sitting silently. Okay, high probably they may ask you this example. Entity holds 20% interest in entity B. That means already you are holding what it is? Associate. Subsequently, it acquires further 50% share. Now what it becomes? This is called a step acquisition. So when we do the step acquisition, there is one way of calculation. We will see that as we proceed further. You paid 300 crores. Now already something was paid some time back, which is 20% stake. Today you paid 300 crores for 50%. So what must be the business value before we proceed further? Can you tell me what is the business value? Today's day, what must be its business value? Business value means what? Value of the business as a whole. 600 crores, simple. AFM. See, if you paid 300 crores for 50% stake, your business must be valued 600 crore, no? That means what is the stake of 20%? 120 crore. You must have invested 10 rupees 50 years back for that 20% stake. But today its worth is 120 crore rupees. Keep it in mind. No, I'm just doing, I don't know, they might have given this information. What you acquired, the fair value of the assets and liabilities are building, cash, financial liability, deferred tax liability also acquired. Fair value of the entity B is 400 crore and fair value of the NCA, okay, it is 400 crore, not 600 crore. But you paid more to acquire to get the goodwill. That's the goodwill. Because you got a controlling stake, no? So controlling stake, generally somebody will pay more than the business value, and that is called a control premium. We call it goodwill. Now NCI is valued at 30%. Now 30% is NCI, no? It's called a fair value option. In NCI there is two options called a proportionate net assets, fair value. The fair value of entities A previously held equity is 80 crores. Okay, what we thought, we valued it based on what they paid, no? No. Somewhere I'll show you this, this assumption, what I have taken just now. Determine whether the acquisition is an asset acquisition or a business combination. No, read further. They decided to apply concentration test. So if we have to apply concentration test, can you tell me, students, some time back you have seen that format, no? You remember that? Okay, so please pause the video and apply the concentration test and tell me whether it is a business combination or asset acquisition. Do whatever, make mistakes, no problem. Just try it yourself. What does, okay, before we proceed, I will just remind you what is concentration test. You have to calculate fair value of gross asset and check whether that is revolving around any single asset. Yes, see, this is only one example given. So based on that, the possibility of this question coming as it is very high. First thing, what is my fair value of the gross assets? For this purchase consideration, 300 we are going to add. NCI 30% they have only give. If they don't give, we know how to calculate, because after this chapter you should be able to do it. And fair value of the 20% stake is this. That means in total for 100% stake, this is what you ended up paying. Okay. Did you took the liabilities also? Yes, add back, because generally you deduct it from the liability. So that is also a purchase consideration paid. Minus, is there a cash? Yes, how much is the cash? 200. Cash and cash equivalents, okay, you are going to deduct it. And your liabilities are 800 crore. Deferred tax liabilities you are not going to consider. Deferred tax asset and liabilities you are not going to consider there. So you get to total 1100. Now, is this 1100 revolving around single asset? If I go back to the balance sheet, see, every asset I took except building. Where we took in this calculation? This is called a fair value of the gross assets. That means this is for your PPE, intangible assets, a group of other things. So in the balance sheet of the acquiree, you took over the balance sheet of an acquiree. No, business combination means balance sheet of the acquiree. For this you paid certain things. You took over the liability also. So, and if you deduct, see, from the balance sheet, in the balance sheet, you got a PPE, you got a cash, you got a liability, you got equity. When you pay for the equity, right? When you are acquiring somebody, what you are paying? You are paying for their equity shares. Exchange for their equity share, they will give it to you, you give them cash. Prithvi, understood? Sorry? Yeah, this is my question. I'll definitely say. My first question is, when the business combination means what? Somebody will sell their share to you, you give the cash to them. So whatever cash you paid here, this is for this. But this is only for 50%. Equity is 100%. No? So these three things together makes 100% of the equity. Are you clear? In the question? No, sorry, I didn't get. Yeah, Baba. Everything is taken over. Your entire balance sheet is taken over. Now, my question is, whatever we are paying them, that's what they said. No, it's an optional test. They wanted to apply this concentration test. The concentration test says that, look, whatever you have paid, what did you pay? I'll ask you one question. Not just cash. See, you paid 500. You paid 500 for the 100% equity. Okay, I'll re-explain again. Please understand this. Yeah, because this is a little tricky. Once you understand, it's simple, very clear to you. See, I have got a balance sheet. Somebody's balance sheet is there. What all components you will find? Equity you find. Liability you find. Liability I'll say. Assets you find. Current assets you find. Say cash. Cash. Now, when you pay someone, what do you pay for? You pay for their equity shares. No. Because their equity shares in your name comes. That means that balance sheet is your balance sheet. This balance sheet belongs to whom? The one whose equity shares, whosever name is there. This balance sheet belongs to them, no? Now, I have paid 300 crores to get this balance sheet. Follow? But this is only 50%. Then another 20% is this, 30% is this, another 20% is this. So that means this 500 represents 100% of equity. Plus, I will take liability also. I will minus this cash. What is left? I got the assets. Now, this is an equation based. Now, I will go to the balance sheet. This asset has got a breakup, or it is one asset. Asset has got a breakup. Now, what I will do, this figure, I will compare one by one for the asset. And check, is this revolving around one asset? Like this, somebody acquires 36 chamber. Now, when they acquire, will they acquire projector also, building also? Will they acquire laptop, books, everything? Now, that asset, me also. So, there are breakup there. Now, when I go through this equation called a purchase consideration minus fair value of liability of plus liability, I should get the assets. Now, which asset you paid? 1100. 1100 is something paid. For whom? If we see the breakup, I see that the majority of this revolves around building. So my objective was to acquire building, not your business, because your building is located in a prime location and I want to shift my business there. I want to stop your business. Whatever business you are doing, I am uninterested, because that more than that cash now I can earn by my business. Say I am into hospitality business. I just want a place. So what I can do, I can go and acquire some barber shop. No? I am a hotel business. I am acquiring one barber shop. What for? I want their business. I want to do barbering business. No. Why did I acquire? I am interested in the building in which this barber's business is located. Now how to test it? Do simple thing. No, this is called a concentration test. Do all these things and check the one by one what did you pay for, and check which asset it is concentrated. If it concentrates around building, then you cannot account it as a business combination. You may call it business combination, but it is not a business combination, it is an asset acquisition. And the moment it is an asset acquisition, this will be accounted like this, not like this. Are you clear about this concept of? Net value, this is called a fair value of the gross asset, should be revolving around one particular asset substantially. If no, then you can say, and substantially is not defined. If no, then you can say it as like a business combination. And if you want to do further test, you can do. So in the given case, 91% of the fair value is concentrated on the building. So it is substantial. So it is an asset acquisition. No, we should. That's what now concentration test equation doesn't includes your building. That building, PP, intangible asset is all balancing figure. only liability will be deducted, will be added as a part of purchase consideration, as if I am directly acquiring it. And this I will go to the balance sheet, take the breakup of the assets and compare one by one. Okay, is this 1100 is majorly revolving any one of the asset? If no, then leave it. No, it is a business combination. If yes, then it is asset acquisition. Yeah, because cash and cash. Will you acquire somebody for their cash? Understood, no? Will I go and acquire somebody's business for their cash by paying my cash? Meaningless, no? That's why they said deduct the cash. And goodwill from deferred tax liability, deferred tax asset and all. Will you acquire somebody for their deferred tax asset? No, already in deferred tax we have seen. Income tax will not permit you to shift the carry forward losses to other group companies. That's why you cannot go and acquire them for your deferred tax assets. So deferred tax asset becomes useless there. Already we have learned that, no? Hiding net asset, yeah. Clear? Perfect? Yes. Yes, yeah, please. Sorry? This is what they say, that when you deduct cash, if there is any deferred tax asset in the balance sheet, deferred tax asset, that also you consider. And if any goodwill coming from deferred tax liability, that also you consider. DTL is given, see, but they have 150, this is deferred tax liability, but they have not considered it. So what I think in exam, they may not give you this. For confusion's sake, they must have given it. Okay, so don't bother, don't worry. If it comes, focus on this particular thing only. Okay, let me check that. Let me check that particular part. It just missed. Okay. Sorry, clear about this business concentration test. Detail, let me come back. Yes. With this, we are done first part called whether it is an asset or whether it is a business. So no more now asset. Now it is business. So before we proceed, so you have to understand one important, very important thing. See, there is one company called P Limited. P Limited, ultimately, any company in the world, who is the ultimate owner? Human being. Behind somebody, one human will be there, no? Somewhere somebody, you will create layers. You may have a trust. Trust will have one beneficiary. Somewhere some human will be there. Except one place, one dog is there, one big trust. One dog, no, ultimate beneficiary of the trust. And luxurious, very rich dog, okay? Somebody died, giving crores and crores of rupees for one, they created one trust. And dog is living one luxurious life there, somewhere in foreign country. Otherwise, generally, humans will be there. So what we will assume that P Limited is held by Mr. X. Now, S Limited is held by Mr. Y. See, understand this. Now, in P Limited share certificate, whose name appears? Mr. X name appears, and he is the owner of P Limited balance sheet. In S Limited balance sheet, Y's name will appear. See, now we say P acquired S. Every question will start with like that. What does that mean? You understand? When say P acquired S, P from its balance sheet, not this X from his balance sheet. From P's bank account, the cash goes to Y. And Y will give what in return? His share certificate. So going forward, S Limited share certificate, after acquisition, P Limited name is going to come, not X Limited name is going to come. X name, not X. Understood this? So the structure will be Mr. X is here, P is here, S is here. Have you understood? See, in this process, what happens? See, it is not that this person paid the cash and Mr. X is named. If that is the case, the structure would have been P, S. Then P should not prepare a consolidation only. There is no consolidated balance sheet only required. CFS doesn't come into picture. If at all Mr. X paid to Mr. Y and took his share certificate, CFS concept doesn't come into picture here because nobody is nobody's subsidiary. Because for humans, Ind AS is not applicable. Only for companies it is applicable. Now what happens because of this purchase? See, from my balance sheet, cash goes out. I am preparing CFS. S Limited, no difference only. No accounting happens in the books of acquiry. Why? Tomorrow if you go and buy MRPL shares, will MRPL pass any entries for that? Will MRPL do anything? No. Instead of one owner, another owner came. What MRPL has to do? MRPL will continue. So accounting entries will happen only in the books of P because for the first time they have to prepare CFS now. Have you understood this logic? Who has to prepare? Because every question starts with P Limited acquired S Limited. Now, what does the meaning of that? Means P Limited paid cash from its bank account to the early owners of Y. So that P Limited name came in the share certificate and S become a subsidiary of P, and as per section 129 of the Companies Act, P is supposed to prepare CFS following 103 and 110 principles. Okay, perfect. Now the cash can be paid to Y in the form of cash or the shares. See, now one more thing happens. Y, Mr. Y. No, owners of X, no. Y is gone. He is enjoying Switzerland. He is no more connected. Now owner is the P. This is the new structure now. This is the new structure of the business where X is at the apex top. Under him 100% subsidiary P is there. Under him 100% subsidiary S is there. Why? Because entire purchase consideration was paid in cash. And Y is not no more concerned. There is one beautiful story, okay. At this point of time it came because it's a company S and all. There was one guy who was the owner of one sugar factory. He was alone, and his son was in abroad, foreign country. So his wife and all nice, he is the only guy. So son calls him, come to foreign, no, come and stay with me. So he goes unwillingly and he stays with the son. But every day, no, he is much worried what is happening to my factory, what is going on now. Okay, he's restless there. One day, son takes the leave and all, and he says, let us sell that factory. He goes and sells the factory and all, and comes back. Okay, all factories sold. It means why sells the factory to somebody else. And after third or fourth day, okay, from that day he gets nice sleep. After fourth day, son tells, okay, our factory got fire, it seems, caught fire. He was sleeping this side, okay, no, and he sleeps that side. So this is called detachment. Sometime back he was attached. The moment he said I sold it, he got detached. When he was attached, if you would have heard that factory got fire, you would have distressed. You see, he disowned it. After Y, anything happens to S, he said, what for me? I am there enjoying my leave. Let the headache take on by the X, no? Nice story, yeah? You go to understand it. Okay? So the cash, see, if you have paid the cash, the structure will look like this, Mr. X, P and S. But instead, what can happen? No. P can issue its shares to Mr. Y. That means going forward, P Limited structure can change like this. 80% of the P is held by this and 20% is held by this, and S Limited becomes 100% subsidiary. Alternatively, he may acquire only 80% of the shares of S Limited by issuing 20% of its shares. The structure will look like this. There is a Mr. X, there is a Mr. Y. X will hold 80%, he will hold 20% in P. P 80% S is held by P and balance 20% is held by NCI, which is this guy. For P Limited, no, this 20% becomes an NCI. No, see, if, okay, forget this. Let me not complicate this. I will issue my shares, but only take 80% of it, not 100%. In that case, the structure will be like this. Mr. X will hold 100% in P, he will hold 80% in S, and the balance 20% is held by Y. For P, it is an NCI. This is clear, right? So P Limited will pass the entries as investment being made by P. So now P has to pass two accounting entries. One in its standalone financial statement, one is in the consolidated financial statement. Both entries are different because in consolidation, investment will get eliminated. In standalone, what is accounting entry you pass? Investment to bank. Which standard? 27. Why? Because it is your subsidiary. Now, no entries are made in the books of S that I have told you because this is a financial transaction between P and the owners of S Limited. So, S Limited will not pass any accounting entry. Is this concept very clear to you? Yes, see, I'm telling you, no, you tomorrow you go and take 20% stake of MRPL. Will MRPL pass any entry that my asset, this is revaluation of fan, revaluation of the equipment and all? They will not do that, no. It's only owners will change. It doesn't make any difference to that entity. But if, see, again, if this acquisition was done by Mr. X from his bank account, why P Limited has to pass the journal entry? Why P Limited has to prepare CFS? It is because P acquired the structure in the share certificate of S, P Limited name is coming. So understood who is passing what entries, no? Yes. Now accounting for business acquisition, only 4 steps. And this is the heart of the third step. Entire calculation goes here. First thing, all theoretical, some chiller pillar will finish just now, like nothing. First step is identify the acquirer. See, if they have to give this as a first step, how tricky it must be. Once upon a time, it was very simple in accounting standard and all. But today, people are trying to fool all around, manipulate. That's why first the standard says, find out who is the acquirer. Why? Because your accounting depends upon the acquirer. First thing, it is already a business combination. Again, we will not talk about asset and all. Forget. Now, if it is a business combination, there can be 3 types of business combination. What all those? Purchase acquisition, pooling of interest, reverse acquisition. Now, what it is? That depends upon who is the acquirer. Is the acquirer totally different from, not connected with the acquiree? Purchase acquisition. If the acquirer and acquiree under the same management before and after acquisition, pooling of interest. If the acquirer is a very small entity and he himself has become an acquiree, a betagara has become beta, the hunter has got hunted. That's the story now, reverse acquisition. He went to hunting and he got himself hunted. Like acquirer became an acquiree. Which acquiree? Accounting acquiree. He is a legal acquirer but became an accounting acquiree. Have you heard these concepts? That is under reverse acquisition. So that's the first step. Second, define the date, because date plays very important, but you don't have to worry. Institute is very compassionate about you. In all the problems, whatever you are going to solve, either the acquisition happens on 1st of April or the acquisition happens on 1st of October. Nice, no? Which in reality never happens. And if at all they give 22nd March acquisition happened and then you sit and do the balance sheet in your exam, then you realize, see, what type of questions they give you. Every single question, either on 1st or the 1st of April, they are 1st of October. Okay, but then recognition and measurement. Okay, so some theory we have to understand, principles, and then we have to understand about the calculation of the goodwill. So we'll come to this first. Acquirer can have normal acquisition, reverse acquisition or pooling of interest method. So in case of a straightforward combination, it is very easily identified who is acquiring whom. Like Walmart acquired Flipkart. Very clear. Walmart is the acquirer, Flipkart is the acquiring. But sometimes business combinations are so complex, it's very difficult to decide who got the control. That's why Ind AS 103 has given a guidance. See, this is a theory. If it comes, you have to write that theory. Theory questions are there in the exam. Now, first thing you need to check, who transferred the cash or who incurred the liability. I told you, no, business combination can happen by incurring liability also. It can happen by contract also. It can happen by issue of shares also. Issue of shares is not the consideration, because again, reverse acquisition also happen by issue of shares only. But the acquirer issues so many shares that he himself will get acquired. So who has transferred the cash or who has issued the equity interest? So there are some guidance, say 6 tests. 1. Relative voting rights in the combined entity. You have to see in the combined entity who is enjoying the voting right. The one who enjoys the largest voting right with the share options, convertible security itself is the acquirer. See, they may do something like this. I will give you you and me, okay, we will form one entity. In this entity, you will have 80%, I will have 20%. Now, who acquired whom? Then it says, you all acquired me in the name of this new company. Means both of us got dissolved. You say, you are you limited. This is you limited. I am me limited. And we both merge together and for us limited. In the us limited, you have got 80% stake. I have got 20% stake. In substance, is it not you are acquiring me? Only for namesake you created on us limited. Even though you would not have created us limited, you would have continued as you limited. Who will ask you? Now tell me, who is the acquirer? You is the acquirer. But when I took 20% plus I got an option for additional number of shares. If I opt, that will give me 80% and you become 20%. I have not opted. I have given 1 year option. That next 1 year, any point of time, I can go, and if I exercise, this US limited should give me additional number of shares such that I end up taking say 60%, you end up getting 40%. Have we solved one question there? Ind AS 28, 30% was there. Somebody new shares were issued, automatically your stake came to 20%. In Ind AS 28, we have solved one problem, no? Previously 30% was there. Additional shares were issued to some independent people. Your stake came down. Like this, when option is given to me and if I exercise, your stake will come down from 80 to 40 and my stake will increase from 20 to 60. Now tell me, who is acquirer? Yeah, right now, see, this is the beauty of the standard. At this point of time, when we combined, you have got 80, I have got 20 plus an option. Tell me, who is acquirer? I am the acquirer. I am the acquirer. Now, you have to evaluate that option. Is that option possibly suitable for me? Is it interesting? Is it possible? No, for me limited, if it is favorable, definitely I will exercise, no. And the day you don't listen to me, what I will do? I will exercise that option. Next day I will come to the board meeting and whoever board of directors are there, no, I will say, finish, go. I will bring my directors there. And the moment I get my directors to the board cabin, done, no, I am controlling all the relevant activities. Every decision I am going to take. So, until that option is valid, can you tell tomorrow I will not give this option? I will go to the court, Baba, I will not keep quiet. Next 1 year, you have to simply listen to me, even though I hold 20% stake. Will you say I will not listen? Do you dare? No, because you also know that there is an option in my hand and that I can execute any point. So understood, no? Yeah, Vindhya, you have doubt? M, me, okay. That's what, no, if you don't, the day you don't listen to me, see, I am 20% stakeholder. And next 1 year, I am to do wait and watch. During this time, I wish the entire operation should happen according to my wishes. So decisions you are taking, asking me, and the day approval note doesn't come to me, and I see that you yourself deciding things, no, I will go and exercise the option. That means literally on day one, who is the business, who is the acquirer here? Who acquired you? Who acquired whom? You acquired me or I acquired you? Me acquired you? No. That's why India gave the guidance there. That's why they added one options and convertible securities also. Second, the existence of large minority interest with no single person holding minority right. You go to some companies, no, all is split 80% of public holding. Now, which public? Not even one person holding more than 1%. Ordinary people and all people holding. Do you think they will come for the AGM there? They are like frog, no. Who will assemble them into one scale? And who will take the unanimous decision there? See, suppose 18,000 people are holding 1%, 2% like this. Will you call all 18,000 people for AGM and make them to take one decision? No. In that AGM, how it works, that's why you should have law knowledge now. How resolution is going to get passed. What happens during the AGM and all. Now, I am the single owner with the largest majority. Like, my holding is only 20%. And rest 80% is held by the general public across India, who will never attend any AGM. Every AGM I will attend with the 20%. I will form the quorum, I will pass the resolutions. Finish, no? I am the acquirer. This is called a minority interest. Are you clear? Third, composition of the governing body who have got the ability to elect the members. See, I don't own anything in your company, but somewhere I have got a right to appoint the board of directors. 3 out of 5. Now, how did you give me? Why did you give me that right? There must be some reason. Family disputes, arrangement, whatever. Yes, then I become the owner of your business. Composition of the senior management. Somebody is dominating the management of the combined entity. That means, who is the chairman of this combined entity now? From your side or from my side? Your side, probably you must be the acquirer. Terms of exchange of equity. Who pays the premium free combination fair value? Your business value was 10. My business value was 15. Now, we exchanged something, shares. So that you got 12, I got 13. Now tell me, who is the acquirer, who is the acquiree? In the combined entity, no, your stake is 12, my stake is 13. Again, I'll explain, please tell me. Again, this is theoretical. In practical questions, you need not apply. See, your market capitalization is 10, yours. My capitalization is 15. And we will form US. What is the market capitalization of US? Now we will go to mergers and acquisition chapter of AFM. What is my combined market capitalization? 25, unless there is a synergy. In this thing, your stake is 12, my stake is 13. Based on some swap ratio, exchange of shares. Now tell me, who is acquirer? You is acquired M or M acquired you? M acquired. Why? Because somebody has been paid a premium over pre-combination fair value. This was your pre-combination. Somebody was paid a premium, and that is in exchange for consideration and relative size of the combining entity. Now, in terms of asset, revenue, etc., somebody is greater. If you look here, no, relatively somebody is bigger as compared to other, no. Then these are all the guidance factors you have to see when there is a complexities. Acquisition date. Generally, the acquisition date is considered as a closing date. That means there will be one last date. On that day, whosoever name appears in the demat register, that person will be the given right shares or whatever. However, the legal agreement may provide control transfer earlier or later. Therefore, control over the relevant activity supersedes the legal agreement. That means on which day you are able to obtain the control to take the decisions. In that board of directors meeting the chamber, there is one chair. On which day you are able to come and sit there? That's the day you are acquired. Now this step is necessary because pre-acquisition profits of the subsidiary is going to become part of the goodwill. There's one method to calculate. I don't do that calculation, not required. My method of working is different. Post-acquisition profit will become the consolidated profit of the, that means this is going to become on this day 103 is going to come, and post-acquisition profit is going to become post-acquisition profit of the subsidiary. Means my parents' consolidated profit. Are you clear? Yes. Now let us look into some theoretical questions of identifying acquirers. So since you are very clear now, so you should be able to tell me. See, this question came in MTP also along with the illustration. Very important question with the numbers, but theory is there. Now you should tell me, company P, a manufacturer of textile, acquires 40,000 shares of company X. Again, I will not tell you now. Now you should have been understood what is the meaning of this. P acquired X means what? Means P paid purchase consideration to the owners of X. Out of 1 lakh shares in issue, as part of the same agreement, company B purchases an option to acquire additional 25,000 shares. That means in the same, one more thing, the option is exercised at any time in next 12 months. Exercise price includes a small premium to the market. That means it is worth, not deeply out of money. After the above transaction, the shareholdings of the P's two other original shareholders are 35,000, 25,000 each. Each of the shareholders has currently exercised option of 2,000 additional shares. They also have got an option. Now, whether the control is acquired by company P, did you acquire the control? Yes, students, so please pause your video. They have gave you certain numbers. I want you to do the calculation and tell me, see, when you acquire control, when you acquire more than 50% stake, that's the general rule. Now tell me, have you acquired that control here using these numbers? You please pause the video, then we will learn how to do the calculations. Yes, students, so what is your opinion? Did the P acquire the control? How do you say? I will challenge you. See, P acquired only 40%, no? They have got 60% combined, because these two people can join hands together and they can drive over P. We have already seen that significant influence. One person director, even though you attend, though nobody cares. They can do, no? These two people can make P like that. Who is, see, P acquired 40% stake of X. Now, who is holding another 60%? Two people called shareholder 1, shareholder 2. You didn't read this fully, I think, or some. After above transaction, the shareholders of company P's other two original shareholders. Okay, it is company X. Okay, maybe probably in the examination also some print mistake like this can happen. So you have to make an understanding. Otherwise, see, does it make sense to you? No, if I keep it as P only, does it make any sense to you, this question? Okay. No, let us understand. That's why first you need to have that overall understanding what I told you, who is buying whom. First of all, you tell me, S is there. What is the share capital of S? 1 lakh shares. You have got P Limited. What is the share capital of P? P is having 40,000 plus 25. See. P has got 35, 25. Then only this much. Now who acquired whom then? Then P went and acquired S. See, P, that means P's holders you are telling, no? Who is holding like this? See, this is going to create a confusion for you. This is not the structure, Baba. Piece holders, they simply, there is a print mistake. There's a P. P means print mistake. That's what you should do. Yeah. Now shall I explain you? If you read this as X, does it make sense? No. First, I don't know how P's will make sense to you. I'm not able to understand that. X. Out of this, 40,000 is taken. Okay. Yeah, that's why understanding question is very important, and that too, if they mix it with this type of print mistake, no, life will become hell there. I will explain you this. See, understand. You have got X. X has got 1 lakh shares. How much P has got? It is irrelevant at this point of time. Who are P's shareholders? None of the question you need that. Now, what you need is who is holding X. That's important. Now, P Limited. Okay. Probably this is held by 3 shareholders. 40, 35, 25. One of the shareholder agrees to get cash from P and sell his shares to P. Now the new structure is X Limited has got 3 shareholders. Who is that? P with 40 and 2 other people with the 35 and 25. Followed? Did he take the controlling interest? No, because other 2 people are controlling. That's why this person must have got fed up with them. That's why he must have sold his stake to P Limited. Took the cash, finished his job. But the P Limited is very smart and professional company. He said, look, give me an option, then I will take this. So he took an option 25,000. Other 2 people are, or once upon a time, old fellows, modern financial management techniques and all, they don't know. AFM and all, they are not learned. So they said, okay, for me 2,000 options are sufficient. Now that the moment this option was granted, 25,000, 2,000, 2,000, who start controlling? P will control. Why? Because without this option, your stake is 40%, to their stake is 60%. You can't control. But the day other 2 people start playing, P will exercise the option because it is commercially viable. What is my stake in that case comes to? It is 40 plus 25. And the day I exercise, they will also exercise. How much is theirs? 37, 27. Now what is the total number of shares? Total value? 40 plus 25 plus 37 plus 27. It comes to 129. Out of 129, what is your stake? 65. 50 point, done, no, I'm majority. So that if it was 3,000, 3,000, they would have taken. Instead of 2,000, 2,000, they would have taken 3,000, 3,000. It would have become 38, 28. 38 plus 28 plus 65. It would have become 131. And you are holding 65 out of 131. 49, chalo, gone. It's not control. Marginally, because of 50.26 something, you get a control. Followed, no? Now it makes sense. Now how to write this examination answer? First you need to do one working note. You have to tell existing stake is 40%. And if you opt, then your stake comes to 52%. But when you opt, possibly they also may opt, no? So the other shareholders' stake comes to 30.39%. What if in examination they say that it is 2,500, 2,500? Then your entire answer is going to change. So in assessing whether the control has been obtained, you have to consider the potential voting rights also. Simply you cannot say 40%. Is there any option? So options are currently exercisable, no other restrictions are there. If exercised, you get 52%. Then if others also exercise, still you get majority. And the premium is very small. So with the acquisition of 40,000 shares, you literally got control over that company. Understood now who is the acquirer? That's why no, today word business combinations are complex. Later during purchase consideration, I will show you. You will wonder, will people do like this? You thought like word is very simple and innocent like you. But word is not innocent, and this is a tool for us to address that. So clear, students? So that question is highly probable. Yeah. Yes. X. You have to read it as X, not P. That's what I am telling you. If P limited stake after the option is exercised by the P limited, then you get out of C. Initially you had 1 lakh. If P exercises option, then the total shares of X limited is going to increase to 125. Out of that your stake is 65. At the moment you exercise, those people also will exercise in X limited. Followed, no? These people are not of P. It is the print mistake. In exam also, see how it will change your understanding. It will change, no? No, anyhow, don't worry. You will get full marks if you attempt this type of question. If any print mistake you find, no, please go and simply attempt it. One more strategy. Simply write something. One more strategy. Who knows? If they give grace mark, no, definitely they will give grace mark for print mistakes. Good, no take. See, ultimately strategy is right. Okay. Next question, which came in MTP. High Speed entered into a share purchase agreement with the shareholders of Fast Move Limited to purchase 30% stake in Fast Move. High Speed is a company which took 30% of Fast Move. Now this 30% is taken from the owners of Fast Move by paying cash from High Speed balance sheet. So that it becomes what now? Associate. As at 31st June 2011 at a price of 30 per share. As per the terms of the share purchase agreement, they have got an option to purchase additional 25% stake of Fast Move before 15th of June 2011. Oh, I am giving just 15 days. At the same price. If you want, then what happened? My total stake comes to 55%. That means controlling interest. Similarly, the selling shareholders also has an option to sell additional stake of 25% on or before 15 at a price of 30. So options are given to both. If I want, I can take 25%. If you want, you can sell it to me 25%. One different odd type of option. Both are option holders only. No, you may not want to sell. But if I exercise option, you have to sell to me. Ulta, I will give you one written option. See here, two options. Two people are option holders, means there should be two writers. So it is a simultaneously cross options. Like, see, it's like, see, I have given an option, put option to you. If you want, you can sell it to me. I am a writer. You have given one call option to me. If I want, I will buy. You have to sell it. Now, who is going to exercise? God knows now. See, it like two. You have taken both the positions now. You are the holder also, you are the writer also. Both of them don't exercise, then gone. That means you have to, because there are two contracts. No, there are two options here. If both the people don't exercise, then I end up with 30%. But if any one party turns out and say, no, I want to sell, I have to buy. No, I want to buy, you have to sell. You never thought about this type of thing, no? See, these type of things do happen. That's why it is very difficult to decide now on that day how it happened. Like what type of combination, what type of things they are doing. Oh. Yeah, that's what. Now question comes, who is the seller? See, first see, it goes like this. You are the owner. You have taken 30% of this from this person by paying him cash. Plus one more option contract you have given to him. You also taken one option. You have given one put option to him. You have taken one call option from him. When you have taken a call option, he has become call option writer. And when you have given put option, you have become put option writer. So ultimately, next 15 days, it is a luck or whatever, uncertainty. Anything can happen. And anything can make me the owner of this business. It's either my wish or your wish. Followed, no? Now, the decision on the relevant activities of Fast Move Limited are made in the AGM. Anything you want to do, you have to do it in AGM only. Extraordinary General Meeting or EGM. Simply you cannot do in a Board of Directors meeting. A resolution of AGM to be passed where more than 50% voters are casted in favor of the resolution. That means right now, I am not in a position to move any resolution. Why? Because my stake is 30%. And I need to convey one general meeting or extraordinary general meeting, call for a general meeting and do it. Maybe it's a small company there. Owners are very few. Board of Director meeting itself is like AGM type of thing. Now, a resolution for the AGM, an AGM can be called by giving at least 21 days advance notice. So, if you want to call for a meeting at least 21 days and within 15 days, this option is going to lapse. Now, with respect to this agreement, you are required to determine whether High Speed Limited has got the control on 1st June. Who controls on 1st June? On 1st June, who controls? Whether on 1st June, is this Fast Move Limited is your associate or a subsidiary? Or are you able to control now with this 30% stake? Why? Why? What about other people? Yeah. No, and one more catch here is other party can't do anything now. Why? Even though right now other party want to call for one AGM, it will take 21 days for the other party. But in my 15 days, option is going to expire. I can exercise that option within 15 days. And other party can't do anything. They can never ever call the AGM because it will take 21 days for that AGM to call. That's what, anyhow I'll be the owner. No. See, in examination, they may take one of the thing. That cross option given to both the parties, no, they may take. Something they may do, but let us understand the solution. 110 says that the investor has got a power. You have to call the definition of control now. When you have got the right ability to direct the relevant activities of the entity. Like I told you in joint control. What is joint control? Jointly taking relevant activity in driving movement is the relevant activity. Correct, no? Or will you enjoy sitting in the car and simply doing like this? Kids will enjoy that. You enjoy only when the car moves. Now, who controls the movement? That's the question. If two people controls it, it's called a joint control. If one person controls it, it's called a control. Now, High Speed has got a 15 days to exercise to purchase 25% stake, which gives the majority 55%. The decision will take at least 21 days to call for the AGM, and more than 50% is required. Existing shareholders can never change the existing policies before the exercise option. Means you cannot stop you from exercising that option. Followed, no? That's why High Speed can exercise the option, get voting right. They have got the ability to direct. So the day you acquired on 1st June, no, you should not apply in days 28. You should apply in days 103. See how it makes a difference. It will not affect. That's what. I asked you by showing this question. On 1st June, what it is? You said associate. See, that's what I'm telling you. We can't go with the traditional analysis here. We have to look into other aspects also and we have to analyze it. Okay, so next one more examination question. Veera Limited and Zira Limited, both in the business manufacturing and selling of the lubricant. Veera and Zira agreed to join forces to benefit from the lower delivery and distribution cost. That means they want to merge. The business combination is carried out by setting out a new entity called the Mira Limited. Like I was giving you sometime example, you, me and us limited. That issues 100 shares to Veera and 50 shares to Zira in proportion to their existing transfer of the shares. The number of shares reflect the relative fair value of the entities before combination. Also, respective company shareholders get the voting rights in Mira based on their respective shareholdings. Now, determine the acquirer. Who is my acquirer here? Mira or Zira? Veera or Zira? On what basis you say? That's fine, the 66%. Then you have to write some theory, no? Which theory you will talk? Yes, Vidya. You have to write some theory, right? So you have to speak about that guidance. There was some guidance, no? I told you 6 items. There you have to say that, look, it is primarily by exchange of shares. Usually the asset one, the one who issued the equity shares, but there can be possibility of reverse acquisition also. In case who has got the relative voting rights. The first point, relative voting rights. So either Veera or Zira will be the acquirer. If you see 67% is held by the Veera. So Veera Limited is the acquirer now. So what happens here? This is a case of a reverse acquisition. We will see that later. Because otherwise, who is the acquirer? You will tell me Mira is the acquirer, no? Who? You didn't understood the question. See, this is Veera. This is Zira. Both of them decided to merge and call them Mira. Mira will issue the shares to the shareholders of Veera. And Veera's shares will get transferred in the name of Mira. Mira will issue its shares to the shareholders of Zira. And Zira shareholders will transfer their shares in Zira to Mira. Now, in both the company's share certificate, whose name is appearing? Mira's name. Now, who is acquired? Who acquired whom? Now, then you say, sir, Mira is the acquirer. Who acquired Veera and Zira? Now, tell me, who acquired whom now? Who is the acquirer here? That's what I'm told you didn't understand the question here. Huh? Sorry? It came, no, it got registered, no. Exactly. So Mira got incorporated as a new entity with 150 issued share capital or authorized share capital. Out of 150, 100 shares they issued to the Veera and they got Veera's shares, whatever it is. 50 shares they issued to Zira. In return, they got Zira's shares. Now, who acquired whom? That's my question. Then you say, sir, Mira acquired. No, this is a reverse acquisition. In the name of Mira, Veera acquired Zira. This is a reverse combination. Now, going forward, we call this person as accounting acquiree, legal acquirer. This person is called legal acquiree, accounting acquirer. No, don't worry now. I'll tell you at the time of reverse acquisition and how the accounting will be complicated now. Tell them, don't do it. Why you are doing this? Why Mira should come into picture, Baba? Why no straightforward? Okay, so Veera is the acquirer. And this is the case where an acquiree himself becomes an acquirer, which is a reverse combination. But exam, if this question comes, you write as it is, whatever they have given you. Don't talk about reverse acquisition and all. Somewhere we have told here, it can happen through reverse acquisition. Next question. ABC incorporated a company called Super Limited to acquire 100% shares of another company called Focus Limited. So you have got ABC. You set up one company called Super. Super acquired Focus. To fund the purchase, Super Limited took a loan from XYZ Bank. Because you need money, no, to acquire Focus. Where is the money? I simply set up. At a commercial interest rate, the loan funds are used by Super to acquire the voting shares of Focus at the fair value in the ordinary transaction. But tell me, how come a bank will give a loan to one newly set up company which has got no assets only? Is it possible? No. Can you see? Understood? No. ABC has set up a Super. Super went to bank, sir, give me loan, and bank gave the loan to acquire this Focus. How on earth that XYZ bank gave loan to Super which has got no assets only? Huh? On the basis of a guarantee. Who must have given guarantee? ABC must have given guarantee. What it was earlier? Outside the balance sheet. Now what it is? Ind AS 109 is going to capture that guarantee, and we have accounted it. We have learned how to account that guarantee accounting, financial liability. Now post acquisition, Super has got the ability to elect and appoint, remove the majority of the members of the governing body of the Focus. And also Super Limited's management is in a power, will be able to dominate the management. State whether Super Limited is an acquirer. Who acquired whom here? Why? What role ABC has to play here? No, see, Super, the going forward structure will be ABC 100%, Super acquired in Focus 100%. This is the structure. But in this business combination, when the cash was paid to the shareholders of Focus and share certificate was taken back, who is the acquirer? Super. Super is the acquirer, no? Yes. But we have to write the theory here. Yes, here Super Limited is the acquirer. Your assessment is correct. But you cannot write simple one line, no? See, ABC setup, this is all confusion. But ultimately, who paid cash to the shareholders of Super Focus? Super only paid. And who is the owner of Focus now? Super is the owner. Who is actually? Because here ABC is not an acquirer. No, see, ultimately there are only two parties, acquirer and acquiree. Now the question, among two, who is the one? That's what you need to figure out. Here the transaction happened between these two people only. So either this person will be the acquirer or this person is the acquiree. This person is the acquirer or this person is the acquiree. Among two, who is the one? In previous there were three parties. Among the three, who is the one? Unknown third party will not come there into picture. So ABC doesn't come into picture. ABC is given structure to the acquisition. But what probably, I will tell you now what they may twist, because there is one more question similar to this. Okay, so you have to tell me, see how things will move on now. You have got ABC. ABC set up what is that called? Focus. On 1st of October. It gave it took the bank loan from XYZ and purchased Super on say 5th of October. Sorry, ABC set up Focus. Huh? Oh, Super. Okay, sorry, Super. And they acquired Focus. Correct? No, this is the status, right? This is they set up a Focus and they set up Super on 5th of October. Now, on 10th of October, ABC acquired Super from Focus. On 10th of October, ABC acquired a Super from Focus. Now, this transaction between ABC and Super, who is the acquirer? ABC is the acquirer. Who is the acquirer? Super is the acquirer. Is it a common combination or it is the purchase acquisition? No, since here point came, no, because in 110 we are going to discuss. Set up Focus, acquired Super. Super. Within next 5 days, ABC will buy Super from Focus. Here the doubt is not the question whether who is the acquirer. In the first transaction, Focus is the acquirer. In the second transaction, ABC is the acquirer. Very clear. Now my question is, in this second transaction, is it a common combination or is it the business acquisition? Sounds like common combination, no? But no. It is called, this setup is called a transitory control. You have to ignore this transition. That's what, it's just a matter of judgment, professional judgment. No, there is one concept called a transitory control. No, yeah, we have not discussed that. We are ready to discuss in 110 because no, why? I will remind you then because similar question we are going to discuss in 110. Similar question. Common combination. Not 110, here only, later. In common combination only we are going to discuss one theory. Similar setup, similar question. Question is whether it is common combination or normal combination. You should say it is normal combination. Why? Because this is a transitory setup, no. Simply for acquiring, ultimately what is the objective? ABC wanted to acquire Super. Simply they set up one Focus in between. So this type of questions will come. So how to answer this? You have to say that, look, who is the acquirer? One who obtains the control. On what basis? Relative voting rights, large minority interest, governing body, senior management, terms of exchange. So we have to evaluate all these factors. So in the given case, since they are able to govern the governing body, Super Limited is the acquirer. Sorry? Okay, since you are curious to know, see, since you asked on the fair value concept, no? See, if it's a business combination, the acquirer's assets are taken over at fair value. If it is common combination, the acquirer's assets are taken over at book value. Book value, not fair value. That's the difference. And no goodwill comes into picture. Capital reserve only will come into picture. Anyhow, we will proceed further. You understand it, you appreciate it. I'm damn sure things will be settling in your mind very well once you understand this, how it operates. Are you clear about these questions? Yes. So now we will discuss about the acquisition date. Acquirer, we have seen scenarios. ABC acquired the shares of XYZ Limited. The negotiations had commenced on 1st of January. Agreement is finalized on 1st of March. So on which day acquired? You should tell me. They obtained the power to control operations on 1st of March. Agreement states that it is effective from 1st of January. That they are entitled to all the profits from after that date. In addition, the purchase price is based on the net of price asset on 1st of January. Determine the date of acquisition. 1st of March. Okay? Because you have to say that, what is that date? Acquisition date is the one when you obtain the control over asset, okay, and then you get the power, exposure to the variable return and the ability to use the power. So it is generally the date, closing date, but the legal agreement may say some other dates. We will not go with the legal agreement date. On 1st of March only, you will be able to take the decisions. Legal agreement say that from 1st January, you will get entitled to get all the profits. But on that time, I was not taking decision, no. From Jan to March, who was taking decision there? So if I can't take the decisions, even though I have got an exposure to variable return, I cannot say I am controlling it. It's like my investment only, but it is not my control. That means even though I may account it on 1st of January, it will act like a 109 up to 1st of March. From 1st of March, consolidation is going to come into picture. Because that day I get the power to take the decisions. ABC and XYZ are the manufacturer of rubber components. ABC Limited makes a bid for XYZ's business. Both are competitors. And the Competition Commission announces that they want to scrutinize this because they cannot allow monopoly. Both are powerful competitors and one wants to acquire another. Complete monopoly, no. Even though the contracts are made subject to the approval, they mutually agree the terms, purchase, everything they discuss, keep it ready. Can the acquisition date in this situation can be the date in which XYZ agree to the terms, or it should be the date when the CCI's permission is approval, because see, that's very substantive. It's not a namesake. That's what they said, that assume approval is very substantive. In examination, if they remove this sentence, you have to write this assumption. 1 mark you are going to get for that. Because sometime, like you have to apply for one name change for a bank. It is one formality. If this approval of CCI is one formality, then acquisition date will be somewhere when you have negotiated and got a control. But if it is not a formality, it is very substantive. That means they can stop this acquisition from happening. Then the day they give me approval, no, that day becomes a, okay, then I have to write the theory here. Closing date, so story. So since it is a substantive, it is the receipt of such approval. One more example they have given you. Till now they have not given in any examination. Just for your academic understanding also you can take it. Company A acquired 80% of the shares when date of shareholder agreement is 1st June. Appointed days as per the agreement is 1st April, like previous question 2 months back. They obtain the control over the representation 1st July. Payment of the consideration of 15 July. Transfer of shares is 1st August. Which day? 1st July. So you say that the 1st July is the date on which the control transfer. Again, 9th April, Sham Limited listed company started to negotiate. 10th, they authorized the management to pursue the merger. 15th May, they made an offer. 31st May, directors accepted the offer. 2nd June, jointly made a press release. 10th June, shareholders approved the terms of the merger. 15th June, shares were allotted. On which day I should consider? Because, see, understand student, in the purchase consideration calculation, you have to calculate the fair value of the equity shares issued. It depends upon on which day the price is what. So, which is the purchase date? 10th June you can consider here. You will write the story here. Okay. 1 minute. No. On 10th June, shareholders approved the terms of the merger. Okay. But problem what happened? No. If they have approved, can they cancel that approval very next day? They can cancel, no. On which day shareholders literally cannot do anything? That's why 15th June is the merger, because on that day literally I can take it. See, I know today somebody makes one, my Guptachar makes one call, sir, today it's approval board meeting, it got approved. Can I go and sit and there tomorrow? No, they will ask you, who are you? Because my name is not registered till now. But the day share certificate, my name gets registered, no, nobody can ask me anything in the question. It's like a vehicle registration. When you are the owner, the moment you paid the money, you are the owner. No, your name should come. No, otherwise they may change that. Things can change. So you have to say that all the shareholders' approval is over there. Issued only on 15. Purchase consideration will be 90. Total purchase consideration will be 10 lakh 80. So they may ask you to calculate the purchase consideration. Highly probable question, because it is sitting in your example with numbers. They are not asked till now. Yes, the next aspect is your recognition and measurement of assets and liabilities.